Good morning and welcome to the MACFARLANE Group PLC interim results investor presentation. Throughout this recorded presentation, investors are being listen-only mode. Questions are encouraged, can be submitted anytime by the Q&A tab situated on the right-hand corner of your screen. Just click Q&A, scroll to the bottom and press send. The company may not be in a position to answer every question received during the meeting itself. However, we review all questions submitted today and we'll publish responses where appropriate to do so. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Peter Atkinson, CEO. Good morning.
Thanks, Paul. Good morning, everybody. I'm Peter Atkinson. I'm here with my CFO today, Ivor Gray, and our objective is to talk you through our half-year results for the first part of 2023. The agenda will cover off three key areas. We'll firstly give a little bit of introduction to MACFARLANE Group, then talk you through the results, and finally turn over to Q&A. So if I begin with a little background to MACFARLANE Group, as a number of you will know, MACFARLANE is a very well-established business, founded about 75 years ago, and is on the stock market, came on the stock market in the early 70s, and has been a fully quoted company on the London stock market since that time. We're headquartered in Glasgow, sales around about 300 million. We've got about 1,000 employees. And as I'll talk later on, we're a very decentralized business. We like actually decentralizing and having profit ownership at a very local level. We operate primarily in the UK, growing in Ireland, and increasingly and fast growing in Europe, with operations in the Netherlands and in Germany. Our customer base is biased towards the UK because of our history, but obviously we are fast growing in Europe. And our business mix is B2B, 75% industrial and 25% retail, of which retail, majority of that is e-commerce customers. If we look at the business is a specialist in protective packaging materials, and we have two operating divisions. We are the UK market leader in the distribution of protective packaging materials. For the uninitiated, that's basically cardboard boxes, void fill to stop the contents of boxes rattling around, tape and stretch. And then we have a smaller specialist design and manufacture business where we design and manufacture very highly spec protective packaging for customers in the industrial, aerospace, automotive, MOD sectors, where they have very high value items that need serious protection. If we talk about our performance history, as you can see on the slide, we've seen consistent profit and earnings per share growth over a sustainable period. And 50% of that growth is built around our acquisition program, and 50% of that is built around our organic growth. How do we maintain our growth? And it's one of the key questions that's come up in the Q&As that we've been given. And there's really six key building blocks to our growth story going forward. Firstly, we've got a very strong leadership position in the UK market, and we continue to grow organically with a strong added value proposition that customers find really interesting and exciting, and it fully differentiates us from competitors. So UK organic growth is a key part of our growth platform. Secondly, UK acquisitions. We've been acquiring in the UK over a long period of time, typically doing 2 acquisitions per year, and we've got a very strong pipeline of further growth opportunities in the UK market. We are very focused on input price management, ensuring that we can work with the right suppliers to drive gross margin performance improvement, and that's a key part of our growth strategy. We are looking to streamline our property footprint. As I'll talk later on, we've just done our first site consolidation in the Northwest, and we've got further site consolidations planned, which allows us to be more competitive in terms of the way we manage our property portfolio. And then from we move to Europe, we've currently got about a 1% share of the European market. So the growth opportunity there is significant. We've got a team operating out of Venlo in Holland that's driving organic growth through a program called Follow the Customer, taking customers we know in the UK who've got European subsidiaries or they themselves are part of a European group, and using our UK relationship to open doors in Europe. And that's going very successfully at the moment. And then secondly, we're obviously very focused on acquiring in Europe. We did our first acquisition in Europe just over a year ago, a company called Pacman in Germany. And again, we've got a very strong pipeline of acquisitions going forward. And then the final components of our growth strategy are continuing to invest in our people. Really makes a difference in terms of in front of the customer. We've got very strong supplier relationships, and we're looking to build and continue to develop those, particularly as we move into Europe. And then finally, as a corporate business, we have a very strong ESG underpin. So we're very confident in the medium-term outlook. So let's move right on to talk about our first half 2023 results. And when we reported our results for 2022, we flagged that we could see that 2023 was going to be a challenging year. Clearly, for general economic reasons, there was a softening of demand. We could quite clearly see that operating cost increases were going to come through, particularly energy and particularly labour costs. And then obviously with what's happening in the banking sector, rising interest costs. So I think what you see in these results is a demonstration of a very resilient business model, because the performance that we've achieved is all being built around self-help programs, because clearly, we've not had any help from the economy at all. And the self-help programs that have delivered the profit growth and the sales growth in the first 6 months are, we've accelerated our acquisition program, completed 2 acquisitions already, hopefully 1 more to go. We've also grown our new business, both in the distribution business and the design and manufacturing business, and distribution new business there is up 24%. We've got increasing momentum in Europe, £1 million more of revenue coming from Europe. So an exit rate this year in Europe of around about 10 million from almost a standing start. And then we've been able to offset most of the operating cost increases, the labour increases, the energy increases I mentioned earlier on, by improved buying, working with our suppliers to get far better buying prices than we previously had. So I think the results that you see demonstrate a really resilient business model. And just over the page, this is how we see the resilience of our business model. We serve across a whole range of different sectors. As I mentioned, 75% of our business is industrial, 25% is retail, the 25% is retail is e-commerce. But even within that e-commerce sector, we're doing health and beauty, we're doing electronics, we're doing food, we're doing clothing. So again, natural hedges. And again, in the industrial market, we're doing automotive, we're doing aerospace, we're doing medical, we're doing diagnostics. So again, spread across a whole range of different sectors with natural hedges. Our biggest individual customer is less than 1.5% of our revenue. So again, that gives us a nice spread. And while we would hate to lose any customer, even if our major customer was lost, it would not be life-threatening to the business. We are a pure protective packaging business. The majority of our competitors, the major competitors we have in the UK, are multi-product distributors. We think protective packaging, 365 days a year, 24 hours a day, we're not distracted by any other product ranges. And we've built up a range of knowledge and expertise, which is no one can compete within the industry. The way we differentiate ourselves is through a very strong value-added proposition. I'll touch on that later in the presentation, but that really distinguishes us from our competitors and allows us to demonstrate real value for customers, not only in terms of products and price, but also in terms of all the added value components that are driven by that packaging choice. Supplier relationships, very, very important to us, and we're well aligned and have got supplier relationships that go back 30, 40 years, and they're a key part of our resilience. We have a strong performance-driven culture. I mentioned in my intro that we devolve profit responsibility to as low a level as we can get it. So it's not just Ivor and I who have sleepless nights about the P&L. We make sure it's right down into the guts of the business. And our sales teams are all driven by gross margin performance, not by revenue performance. So again, there's not the vanity of sales. It's actually about driving bottom line performance. And finally, majority of what we do is bespoke for the customer. In our distribution business, 70% of what we do is bespoke for their requirements. And the design and manufacture business, 100% of the things that we do are bespoke. So we're not just selling any old piece of packaging. We're trying as much as possible to develop and design packaging that's personalized for the customer. So, and I think that resilience is the thing that underpins our first half performance. So with that as a little bit of background, I'll pass over to Ivor just to talk you through some of the specifics with regard to the numbers.
Thanks, Peter. Good morning, everyone. This slide will just cover some of the key financial metrics of the business in the first half of 2023. So just to looking along the top there, our revenue and profit metrics, we grew the business by 2% in the first half of the year. And that is a combination of 6% improvement related to the acquisitions we did. If you remember, we did the acquisition of Sutton Packaging in March this year. and Gottlieb Packaging in April this year, and that's added 6% into our sales line. And we've seen weakness in the organic growth, so we've seen organic growth go back -4%. And the kind of breakdown by division is distribution's been flat year on year, and the manufacturing businesses moved forward 13%, clearly with the benefit of the Suttons acquisition, as well as some good organic performance. In terms of the profitability, we've moved the profitability forward by 13%, and that splits down 6% improvement within distribution, 36% improvement in manufacturing. Clearly a strong input from the acquisitions, but we have seen some organic improvement in profitability. So despite the weakness in sales, and we've seen some inflation in operating costs, the strength of our gross margin has flowed through to a strong bottom line. In terms of the returns and balance sheet, we've maintained a strong return on capital employed, 18%, similar to last year. Our bank debt has nudged down from 3.4 million at the end of 2022, now to 3.3 million, and I'll cover the cash flows a bit more detail in a minute. And it's pleasing again to see our pension surplus move in a positive direction from 10.2 million at the end of December to 12.8 million at the end of June this year. And in terms of our EPS growth has been 9%, not as significant as the profit growth of 13%. And that's really because of the increase in tax rate this year in the UK from 19% last year to 25% from the 1st of April this year. And again, we've managed to increase our dividend, reflecting the improvement in profitability of our business from 0.9 pence to 0.94 pence. Just moving on to the results of the business, just want to cover off a couple of points in this slide. Peter will cover off some of the kind of sales features as he delves down into the kind of individual business performances. But you'll notice from this slide that the gross margins improved significantly year on year, and that's a 1.9% improvement within the distribution business and a 3.7% improvement in manufacturing. And that's really helped to offset some of the incremental costs we've seen on our overheads. So the overhead increment year on year is broken down primarily acquisition related, so 2.2 million of incremental costs related to the fact that we acquired Pacman in June last year, so we only had it for 1 month last year. We've had it for 6 months this year, and as I mentioned earlier, the 2 acquisitions we did this year. But also we've had inflationary increments on our employee costs and energy costs. So this time last year, if you look at our energy costs, we spent £500,000 in the first half of last year. That's more than doubled to £1 million in the first half of this year. And we've also seen inflation in employee costs. The wage increase that we gave our staff at the beginning of the year, our lower paid staff were paid 8% rise, going down to 3% for the higher paid. So it was a blend of around 6 to 7%, and we've seen that flowing through our employee cost base. However, that's been offset partly by the fact that we've used a lot less temporary staff through the course of the first half of the year, reflecting the lower volumes that we've seen in the business. Just moving on to the cash flows, as I described earlier, we've actually improved the net debt position by 100,000 in the first half of the year, and that's really down to a strong inflow from the operations of the business. You'll notice the working capital. Part of the reason the working capital has been so strong in the first half of the year is good management of working capital, but also an unwinding of working capital as we've seen lower volumes towards the half year compared towards the full year last year. And you can see that we spent quite a significant amount of money on acquisitions, and that 11.4 million is broken down to 2.9 million related to earnouts related to the GWP and Carter's acquisitions that we did 2 years ago. So they were on 2-year earnouts, and we've now made the final payouts. Both businesses performing extremely well. And 8.5 million is the initial payments that we made for the Suttons and Gottlieb acquisition earlier this year. Just for information, we have a further 2.5 million outstanding on earnout for the Suttons acquisition, 1.25 million for next year, and 1.25 million in 2025. And we have 800,000 of earnout opportunity in the Gottlieb acquisition, 250,000 next year, 550,000 in 2 years' time. The capital expenditure, 1.3 million. The main capital expenditure we had this year was the opening of our Northern Innovation Lab. Peter will touch on that when he discusses the packaging distribution business, but more than half of the CapEx spend this year is on the opening and investment in the Northern Innovation Lab, which should give us some real benefits in terms of new business opportunities going forward. So again, a positive outlook, a positive inflow of cash in the year, despite the fact we've made significant investments in both acquisitions and capital expenditure. So I'll pass back to Peter now to cover some of the detail around the individual business operations.
Thanks, Ivor. So I'll talk first about the packaging distribution business, which, as you know, is our main business. And we talked about the economic headwinds that we were facing, and we've been able to offset those headwinds by the benefit of the acquisitions, the Gottlieb acquisition this year and the Pacman acquisition just over 12 months ago. In addition to that, we've done a really good job in accelerating our new business momentum. So our new business growth was 24% up on the same period a year ago. And we're also starting to benefit in terms of new business from our innovation lab, which Ivor touched on. So this is the second innovation lab that we have opened. This one is up in Hayward in the northwest of England. And it's really a place where we use it for customers to bring them in, to understand their business, to model their cost structure around packaging, and then to send them away with a fully costed proposal and samples of products to allow them to evaluate and make decisions. So it's a key part of our new business growth platform in 2023 has been the opening of the new innovation lab in the northwest. I mentioned about our gross margin performance, and because of the operating cost increases that we've been incurring, we work with our suppliers to actually negotiate better buying prices, and that's allowed us to more than offset the increase in overhead costs. Two other things I just mentioned: Net Promoter Score. I think most of you are familiar with. It's a sort of quite a sophisticated customer service measure, customer loyalty measure, and you can see a dramatic improvement in the Net Promoter Score in the period. The average for B2B companies is 25, so we're way above average. The top performers are, in the 70s or 80s. So we're nudging some of the top performers, but I think it's demonstrating how effective the customers value what we do for them. And then the other number sort of reference for you is our net margin, our PBIT margin, currently 7.6%, up from 7.2%, and beginning to nudge the 8 to 10%, which has always been our medium-term target for the distribution business. If I just dig into the overhead costs in a little bit more detail, the key feature here is the employee costs, which I've just talked about, and we've been able to offset a big proportion of the inflationary wage increase that we gave by reducing our base of temp workers. And then at the same time, we've got utility cost increases, but both those major cost changes we've been able to offset by the improved gross margin through better supply negotiation. And on that point, in terms of the raw material pricing, what we've got here is a graph that shows you the last couple of years in terms of how the two key raw material indices that decide what prices we buy at, how they've moved. 70% of our business is paper related and 30% is polymer related. As you can see, we've seen a steep rise in both those up to sort of the middle of 2022, and then the prices have started to come down, partly market related, partly supply demand related. I think the important thing about this slide is that if you track these graphs back for probably 10 years, the important measure is the stability of our gross margin. So whatever is happening with raw material prices, upward or downward, we've got a very demonstrable, effective track record of being able to translate raw material prices into selling prices to underpin a strong gross margin. Next slide just gives you, I won't go through all the detail here, it's quite well populated, but just this is the agenda the distribution business are working to. Top right is important. We've got some new software programs we've introduced. Major one is around customer relationship management, and we're in the process of now beginning to see the benefits coming through from that. So that is good news for us going forward in terms of our ability to engage more effective with customers in terms of improved retention rates and improved product penetration rates. Bottom left-hand corner, we're in the process of developing a new program to improve our online capability. In relative terms, we would argue our online capability is not as strong as it should be. So work going on there, investment plan for 2024 in terms of improving our online capability. And then bottom right-hand corner, the property footprint. As I mentioned, we've done our first site consolidation in the northwest, and we've got further site consolidations to go to actually streamline our property footprint consistent with our customer service metrics, but also to ensure that we are always in control and are able to sort of keep our operating costs under control. If I move on to design and manufacture, becoming an increasingly important part of the group, and is now sort of moving towards quite an important number in terms of 30% of group profitability. Key thing to note here is a strong performance from the Suttons acquisition that took place early on in the year. Very pleased with that business acquisition. And then again, we've got some really good new business momentum, some strong new business wins in H1 2023, which will help us in the end of 2023 and into 2024. I think most of you are aware that the design and manufacture business partners with the distribution business. They are a supplier too of specific products and specific solutions. And we're increasingly encouraging our distribution business to use our design and manufacture facilities as in-house suppliers to keep profitability in-house, and we're getting some good momentum in terms of that. And a similar action plan in terms of the agenda for the design and manufacture business going forward. Top right-hand corner, utilising both GWP and Suttons for more in-house supply opportunities. We've yet to evaluate the European opportunity for this business, sort of in the middle and the bottom rank there. But we'll be doing some work going forward to see what opportunities there are to actually move this business into Europe as part of our underlying growth strategy. And then, as you know, we have done a couple of acquisitions in this space recently, and we see further opportunities for acquisitions. We've got a good pipeline, and so hopefully more growth to come from our acquisition activity. I'm just moving over to acquisitions. I've got this slide in the pack just to give you a flavour of our acquisition history. Typically doing 2 or 3 acquisitions per year. We have very strict acquisition criteria. We only target quality businesses. We're all too busy to spend our time fixing damaged businesses. We've got a strong pipeline in the UK, got a strong pipeline in Europe. And the good thing is when we buy businesses and when we integrate businesses, typically around about half the owner managers who thought they were planning to retire have decided to stay on with us, which is obviously an effective recommendation for the way we go about buying and integrating the acquisitions that we make. So more acquisitions to come, and as I said, it's a key part of our growth strategy. If I move quickly on to ESG, clearly a range of investors, this becomes an important part of their agenda, and we recognise that. The key things that we've been focusing on are firstly reducing our own environmental footprint, the impact we're having on our operations have on the environment. And the major feature there is how do we find a way of replacing 120 diesel trucks, because they are the major carbon emissions that our business makes. So we've started off with a program, a steady program of introducing electric trucks. We've currently got 5 on the fleet. It's very early days, but certainly the feedback we're getting from both our staff and as importantly our customers is very positive. So we will see how the technology develops, and our objective at the end of the day is to find a way of replacing our diesel fleet of trucks. In terms of supporting our customers, I mentioned the Innovation Lab. The Innovation Lab becomes a fundamental tool in helping our customers and to help them, guide them, advise them, direct them on how they use packaging and how they use it, making sure they use sustainable products and they use as little of it as possible, but as much of it to ensure that the product that they are shipping is protected so they don't incur damage and all the CO2 footprint increase that comes about damage and returns and so on and so forth. So we've got an extremely good track record of working with our customers, and we would argue it's part of our key differentiation from our competitors as to how we work with our customers to support them in reducing their environmental footprint. Clearly, our commitment to our staff and the way we treat them from a health and safety point of view, from a training, development, communication point of view, we've sort of been doing that, even before ESG was invented. So we're very happy with the progress we're making, and we'll continue to drive forward in that area. And then finally, from a governance point of view, one of the key areas that we were concerned about was the diversity, particularly around the board. And we've now got a better balanced board with a more diverse board. So again, making good progress in that area as well. So let me move back to Ivor and we'll talk through the pension, and then I'll make some concluding remarks before we go into Q&A.
Okay, this slide just gives you a wee bit more flavour for the movement in the pension surplus. As I said earlier, it's pleasing to see the surplus moved in a positive direction, and that's primarily driven by the fact that the discount rate has increased from the end of last year from 4.8 to 5.3%, and that's reduced the liabilities. And that's matched by the movement in the liability-driven investments. The liability-driven investments are there to hedge any movements in inflation and bond yields, and that's really doing the job it was made to do. And we're getting the benefits of movements in the other assets, primarily equities, and also the fact that the company put a further £600,000 into the scheme in the first half of this year. So in terms of cash outflows going forward, the company's committed to paying a further 1.25 million into the scheme between now and April next year. We are going through the process of a further triennial valuation now, which should complete around about February next year. And I would fully expect that the cash outflow from the company going forward will significantly reduce from its current levels. This then just gives you a kind of breakdown of the assets that are held in the scheme. What we'll now be doing now that the scheme is in surplus, and really the plan of action now is really to have the scheme self-sufficient going forward, and looking at options for buy-in and buy-out in the next kind of 2 to 4 years. We will gradually be moving that asset base away from the more volatile assets like equities to more stable assets like the multi-asset credit fund we've got there. So you will see quite a movement in the assets as we go through the second half of the year, and that's really just to lock in the surplus we've got and be in a position that the pension scheme can be self-sufficient. So you can see the right-hand side in terms of the pensioner base. It's a mature scheme. We don't have any active members. The scheme is closed to future accrual last year, and a majority of the scheme members are actually in pensioners at this stage. So again, the scheme's well funded, in good shape, being well managed, and really from an investor point of view, the important thing is the cash withdrawal from the company is getting less going forward. Pass back to Peter just to give you a kind of summary of the presentation.
Thanks, Ivor. So I guess the key takeaways from our first half, the half-year results for 2023 are the challenger headwinds, us sort of pivoting towards self-help actions to offset those headwinds, and really reflecting and demonstrating the resilience of our business model in terms of our sales performance and our profit performance. Both have grown. And in terms of the second half of the year, as part of the announcement with these results, we announced that our profit expectations for the full year were unchanged. The medium-term outlook for the business is very strong. We're well funded. We've got healthy acquisition pipelines. We've got good organic growth momentum. So we feel that we're well set up for the remainder of this year and for the next 3 to 5 years. And my final slide is just a sort of a refresh of the MACFARLANE business case. You know, we have simple, flexible, and resilient business model. We've got 2 strongly focused operating companies, both of which sell a differentiated proposition to their target customers. Both businesses have got good market positions, strong players in both markets, but with significant growth potential. And clearly, if you look at our historic performance, we've got a track record of growth, and we've got a plan for future growth. So thank you for your time this morning. We'll now move over to Q&A.
Fantastic. Peter, Ivor, thank you very much indeed for the presentation. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab just situated on the right-hand corner of your screen. But just while the team take a few moments to review those questions submitted today, I'd like to remind you that recording the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Peter, Ivor, we have received a number of pre-submitted questions from investors, and I wanted to perhaps kick off the Q&A session with those, and we'll move on to any further ones we get live. One you have kind of covered off, but if there's any further to add, it reads as follows. Could you explain your growth plan, in particular acquisition opportunities internationally? Would you consider using higher debt leverage to achieve higher return on equity?
Yeah, well, hopefully in the presentation, thanks for the question. Hopefully in the presentation, we have described our growth plans. We have built up a strong pipeline in the UK, and we've been executing against that pipeline on a consistent basis. We've now got an equivalent pipeline in Europe, and we're focusing on Scandinavia, Benelux countries, and Germany are our 3 target geographies. So we've got a similar strong pipeline there, and we're building up, doing the courtship with the acquisition targets, and we are very, very positive about the opportunity to grow through acquisition, both in the UK and in Europe. A key part of our strategy going forward in terms of our growth building blocks. I'll pass over to Ivor about the funding question.
Yeah, I mean, as you know, we've got a 35 million bank facility, and we're certainly not frightened to use that facility to do the right things. I mean, clearly our priorities in the business are to invest in the business for the organic growth. We clearly want to continue to pay a progressive dividend as the profits improve in the business. And really the third priority is really acquisitions. I mean, clearly we've been successful with acquisitions over a period of time, and we certainly want to continue that programme going forward. So primarily that's our focus. Clearly, if the business generates excess cash and we don't have those opportunities to invest, particularly in acquisitions, then we would look at other ways to return money back to shareholders. And that's something that's always under consideration by Peter, myself, and the rest of the board.
Fantastic. Thank you very much indeed. I think this one's definitely for you, Peter. We all love Peter, so it'd be good to have some idea of how much longer he plans to stay in the job. Is there any succession plan in place?
So, easy one to answer. I've got no plans to leave, and yes, the board is working on succession plans.
Perfect. Thanks, Peter. You have touched on this again in the presentation. The question reads really as follows. In the risk section, it says you have 1 freehold and 52 lease sites. This sounds like a rather inefficient use with a lot of small warehouses, presumably due to the various acquisitions you've made over the years. Would it be better to consolidate into fewer larger warehouses and automate processes instead of operating out of numerous smaller warehouses?
Yeah, I mean, as Peter described earlier, I mean, we've already started our site consolidation. We did one in the Northwest. The next one's planned for East Midlands, where we're looking to consolidate 4 sites into 1 larger site near the East Midlands Airport. So the plan going forward clearly is to move from some of the smaller sites to larger sites. Yeah, right. I mean, part of the reason we've got lots of smaller sites is because of the acquisitions we've done over time. But probably, certainly, if you look at the number of lease sites we've got, we do have a number of leases where sites are very close together. So if you take our site configuration Wolverhampton, for example, that's 1 operation, but we've actually got 4 leases with sites that are very close together and operate as 1 unit. But yeah, no, the strategy going forward is certainly to move to larger, more efficient sites where it makes sense. Clearly, the things we have to consider there is in the process of change, we have to absolutely minimise disruption to both employees and customers, because otherwise the benefits you get from the consolidation easily get eaten up if you don't look after your customers and look after your employees in that transition.
Yeah, just to add to that's to me the key driver of our property footprint. Is we need the property footprint to make sure that we can serve our customers effectively. In effect, our warehouses become our customer warehouses, so our proximity to customers is a key part of our DNA. So while, yes, we do recognise we have got opportunities for site consolidation, unlikely in the near term we'll move to a low single number digit number of sites. It'll be sites that are there to support our customer base. Just a reminder, 90% of the orders we take today, we deliver tomorrow. So we've got very tight turnarounds, and that drives, in a way, the proximity to our customers' locations.
That's fantastic. Thanks, Peter. Thanks, Ivor. Last one we've got here, a bit of a statement/question. Could you please start reporting adjusted EPS, stripping out amortization of acquired intangibles to give a true picture of your profitability and align with both your house brokers forecast and your peers?
I mean, clearly we'll take that into consideration. I mean, clearly as a business, we always want to give consistency of information to our investors year in, year out, so that when they're looking back, they can measure the business over a period of time. We do tend to try and avoid adjusted measures where possible. We do provide operating profit before amortisation within our results, but that's the only alternative profit measure we use. But clearly we want to provide information to investors that are useful, so we will definitely take that under consideration.
That's fantastic. That concludes the pre-submitted questions. As you can see, we have had a number of questions throughout today's presentation. Thank you to all the investors for submitting those. Ivor, if I may perhaps just hand over to you, just click on that Q&A tab and start at the top, and just where appropriate to do so, read out the question or pass it to Peter and give your response, and I'll pick up from you at the end.
So the first question we've got here is, you claim to be UK market leader, but what does that mean in terms of market share? So I mean, I'll answer that one. In terms of our market share today, in terms of what the market that we operate within, which is the defined market of protective packaging distribution, then we have circa somewhere between 20 and 25%. If you look at the protective market as a whole, which is significantly larger when you bring in all the manufacturers into it, then clearly it's about 6 times less than that. But in terms of the pure market that we play in, the protective packaging distribution market, our market share is somewhere between 20 and 25%. The second question I've got here is, can you give us some more detail on your acquisition criteria and about your post-acquisition philosophy, please?
Yeah, I'll pick that one up. So what we do is we do a huge amount of desk research on acquisition targets. This is the UK and Europe. We build up knowledge from our supplier base, and we build up knowledge because particularly in the UK, a lot of the distributors that we are looking at and evaluating are also competitors. So we can get a judgment of how we're competing with them and how they're competing with us. And as I mentioned in my intro, we only focus on quality of businesses, and quality to us is quality of returns, that they are added value distributors, they are doing more than product and price, and quality in terms of the culture of how they operate and how they do business. And obviously we pick up that because we know them as a competitor. So that's the criteria we use. Alongside that, we look at some, where are they located? Are they overlapping with us, or are they in areas that we're not very strong geographically? What is their product mix? Does their product mix overlap with us, or does it complement what we do? And then also we look at their supplier base as well, in terms of what are the opportunities in terms of supplier base overlap. So that's all the pre-work we do. We then engage and we do all our acquisitions ourselves. So we view it important that we, as the leaders in the business, we engage directly with potential sellers. So Ivor and I drive that program. And when we get to an agreed process, an agreed program, we agree a value for the business, and then typically we agree growth targets for the business as well, and we pay 70% of the agreed valuation up front, and then the remaining 25-30% we pay on an earn-out basis over 1 or 2 years. Majority of the businesses we buy achieve the top end of their earn-out targets, which is obviously really good for them and for us. In terms of integration, we do soft integrations. So we start off looking at supplier synergies. We then start looking at back office synergies, and then we look at sales synergies, recognizing that for 12-24 months these companies are in an earn-out process, so we don't want to do too much interference to avoid the risk of them potentially getting involved in messing up their earn-out. So soft integrations, careful integrations. Key thing for us is keep the staff, keep the people. Where there are big opportunities for cost savings, integration cost savings, it tends to come where we can make property moves. So we can move our business into the acquired company's property or the other way around. And certainly on some of the acquisitions, we're able to do that. But again, the priority is in doing that, make sure we keep the customers, make sure we keep the staff, make sure we keep the service. So I think hopefully that covers off most of the points in that question. Thanks for the question.
Just moving on to some questions on the market itself. Can you provide some colour on your main customer sectors around market share and growth opportunities? And is the e-commerce sector stabilised, or is demand still falling following the pandemic?
Okay. Let's start with the second part of it. We're still seeing the e-commerce sector adjusting, because obviously, during the COVID period, we all had not much to do but press buttons on computers and buy stuff. Stores were closed, so customers pivoted towards e-commerce. So the market is still going through some adjustment. So part of what we're seeing in our first half year numbers is lower e-commerce revenue than previous, because of that spike that we saw during the COVID period. If we look at our e-commerce revenue pre-COVID, we are 15-16% ahead. So in normalized terms, we're still growing. And if you look at the industry sectors, if you look at e-commerce in terms of the total e-commerce industry, again, if you take out the spike, the IMRG stats show that the e-commerce industry, taking out the spike, the trend is continued growth, and there is expected to be continued growth going forward. So for McFarlane, e-commerce represents about 25% of our business, and we see that about the right level in terms of the blend and mix. Within e-commerce, we've got no one dominant sector. As I say, we do a lot in the home furnishing sector, we do a lot in the electronic sector, we do a lot in the health and beauty sector. But within that 25%, there's no one sector that's more than 5% either.
Yeah, correct.
And in terms of the industrial markets, again, a strong blend of sectors that we service. And it's part of our sort of sales strategy and our marketing strategy not to get overweight in any one sector. So we've got these natural hedges. So the strong sectors for us in the industrial market are aerospace, automotive, industrial consumables, electronics. And again, you've not really got any one sector that's more than around about 6 or 7% of that industrial market either. So, back to that resilience story, the resilience we have is based on the fact that we're not overweight or over-dependent on any one sector, either in industrial or in e-commerce. And yes, we still see e-commerce as a good place with growth credentials.
Okay, thanks, Peter. Just now one on gross margin. Can you expand on the drivers contributing to the gross margin improvement, and did you see this as sustainable?
Good question. 2 key points here, really. One is we've got a very good, as I mentioned in the presentation, we've got a very good track record of translating buying price movements into selling price movements. And that's been proven and tested over a long-term period of time. So we're very happy with the model that we use to ensure that we can translate buying price into selling prices. What we're seeing at the moment in terms of trends is obviously softer raw material prices. And we're benefiting from that in terms of our buying prices. And then we're working with our customers to ensure that we translate those buying prices into selling prices, but are able to sustain our cash gross margin and at the same time pay for the increased labour costs that we're incurring and the increased energy costs we're incurring. So from our point of view, we see the gross margin as sustainable. It always sort of nips around, 0.5%, 1%, but that mid-30 gross margin in distribution, early 40s to mid-40s in manufacturing. We see those as sustainable levels. And relative to our competition, they're not out of line with any of our major competitors in either of those sectors.
Okay. Another one here, just on the market rating. Your stock market rating appears far too low, 9 times PER next year. Given track record and opportunities, has this unfair rating hindered you from making larger acquisitions?
Sorry, is that?
Yeah.
Read it.
So your stock market rating appears far too low. Has this unfair rating hindered you from making large acquisitions?
The stock market rating is the stock market rating. We just continue to drive the performance of the business, and the stock market will judge accordingly. Has it impacted our ability to make larger acquisitions? No. The acquisitions that we make, we want to make sure they're within our operating bandwidth, and I described the acquisition criteria previously. We're not afraid of making larger acquisitions, but it's just that the opportunities that we're working on at the moment and have delivered, executed previously, are in what we would call our sweet spot. And when you look at some of the larger companies, they fall out of our criteria in terms of maybe performance or culture, or some of both the hard numbers and the soft things that we use for criteria.
Here's one on the pension scheme. It's positive to see a pension moving in the right direction. Can you talk more about the medium-term plan for the pension scheme? I think I covered that off earlier. I think the short term is obviously to get the scheme to be self-sufficient, so it's not drawing on additional funds from the business. But obviously in the medium term, it's moving and investigating opportunities for buy-in and buy-out. And given the well-funded position of the scheme at the moment, then we're certainly in a good position to investigate that properly. Another one here, just one on volumes. Are you concerned about volume trends? It looks like volumes are down mid-single digit. How do you know you're not losing market share and that the volume will come back?
Yeah, good question. We don't see ourselves as losing market share. We see the volume decline consistent with the industry metrics that we have access to. The very fact that our new business is 24% up versus the previous year demonstrates that we can continue to grow organically. And as I mentioned earlier on, clearly the acquisition program we've got will allow us to increase growing our market share. So good question, but no, we don't see the volume decline being about market share. It's more to do with what we see happening in the broader market.
Another one here. Do you expect the European business to have a similar EBIT margin than the UK business from 2024 onward, or is it a mid-term target? What could this split between distribution and manufacturing be in 5 to 10 years? And should we expect most of the future acquisitions to be in the manufacturing segment?
Start with the last question first. So no, we see, our major business is packaging distribution. And so the balance of acquisitions will probably be slightly biased towards packaging distribution, more so than manufacturing. Do we see manufacturing acquisitions as a good opportunity? Yes, we do. Do we see the balance between distribution and manufacturing changing materially? I don't think we'll see it changing materially. The balance at the moment is probably slightly overbalanced towards distribution, so maybe we'd slightly nudge manufacturing up a little bit, but it's not going to be a material change. And which one did I miss?
European margins.
European margins. Yeah, the work we've done so far is indicating that net margins in Europe from European distributors are not materially different from the margins that we're seeing in the UK. So we don't see dynamics currently that would indicate that net margins in Europe should be materially different from those that we see in the UK.
One here related to the Gottlieb acquisition. Gottlieb appears to be a fairly generic packaging distributor, but higher margins than the rest of McFarlane. Was the company able to learn things from Gottlieb that we're able to implement elsewhere to improve margins?
Yeah, good question. When you look at our business in broad terms, into distribution, we've got 60% of our business which is in larger customers, annual spend 100,000 plus. We've then got about 30% of our spend in medium-sized customers, so that 10,000 to 100, and then we've got about 10% of our business in customers who spend less than 10,000. The benefit that we have in terms of margin mix is clearly the larger customers, the margins there tend to be not as strong, while the smaller customers, the margin tends to be a little bit higher. And what we've got in a company like Gottlieb is a really good family-owned local distributor operating in that local customer sector. So that's the reason why they're able to deliver the sorts of margins, because they don't focus on the bigger, larger national customers. But yes, there are things that we learn from all our acquisitions, and certainly the way Gottlieb go about working with customers and developing customers in that local sector is certainly something we can benefit from. But all the acquisitions that we make, Gottlieb included, we start with the principle of these are successful businesses, they're doing well. What can they teach us, and what can we use in their business into our business to improve our performance?
Okay. With the current valuation of McFarlane shares only slightly above the price you tend to buy companies at, isn't there an argument for diverting funds from the dividend and acquisitions towards buyback? I mean, I think we covered that. I mean, primarily our focus would be in developing the business, both organically and through acquisition. You are correct in terms of the valuation at the moment. Excluding IFRS 16, we're probably up towards the high 6 compared to acquisitions we're doing between 5 and 6. There is a difference, but not significant. So it's certainly something that we keep under consideration, but clearly our preference would be to invest in the business, both in terms of organic growth and acquisition, and obviously use buybacks where we've got an excess cash position. But we do understand that investors more and more are looking at this, and it's certainly something we're taking under consideration. Trying to see if there's how does the -4% organic growth break down between volume decline and price increase?
The majority of that is volume. We're not yet. We began to see, as we exited H1, a degree of price inflation coming through, but in H1 as presented, it's predominantly a volume effect more than a price effect.
One on the returns. So historically, you've generated about, I think it says 40 return on invested capital over the past 5 years. Do you expect to generate these types of returns going forward? What are the drivers to generate these returns, and what are the outlook for these drivers? I mean, I suppose the key driver is a relatively capital-light business. It doesn't require significant amounts of capital expenditure. The operating cash flows are very strong, and I don't see really going forward that changing much over the next few years. Clearly, we have to continue to invest in the business. On the manufacturing side, if you think of our manufacturing side, it's a large degree of its assembly work with some automation. So it's more capital intensive than distribution, but maybe it's not a significantly capital intensive business. And clearly the distribution business is very capital light. All of our properties and all of our vehicles are leased. So it doesn't require significant amounts of capital expenditure. So I think the main things are maintaining the margins in a business, managing the working capital well, which I think we do a good job on, and obviously it's relatively capital light, and I don't see these factors changing significantly going forward. Let's see if I can go back and see. There's one question: is there a forex issue? I'm not quite sure I understand that question, to be fair, but we don't have a huge amount of foreign exchange exposure. Most of our businesses operate overseas, operate within those geographies. So there's not a lot of crossover of currency, and there's certainly not a significant impact on our profitability and our sales line because of movements in forex. So if I haven't answered that question well, please obviously elaborate on the concern that you may have in that particular area. A few on gross margin, which I think we've covered. Obviously, one referring to our new managing director of the distribution business. Just simple question: does that free up time for you, Peter?
Yeah, it does. Yeah, it's taking a lot of my workload. No, it just strengthens our leadership team. That's the most important thing. He is a real true professional in the market, having worked at Sealed Air for a long period of time, and more recently working within the Bunzl protective packaging business. So he's known to us. I've been trying to bring him into the business for quite a long period of time now, and we finally got him on board. And certainly we're very pleased to have him on board, and his contribution already has been important to us. So it just strengthens the team to underpin and support our growth plans going forward.
Let's see if I've missed any kind of questions that we maybe not covered. There's one here. So the company doesn't give like-for-like sales figures in the results announcement. Is this not a key information gap for an acquisitive business?
Don't understand that question.
Yeah, I think the question, Peter, is breaking down the growth year on year between the acquisition and the organic sales.
Okay.
And we probably gave a lot more detail in our annual report, probably certainly in our interim report. If you go to the management report side, we do disclose the growth impact of the Pacman and Gottlieb acquisition and distribution. But I suppose just to be clear on that for everyone, if you look at the revenue on distribution, growth of 500,000, 6.3 million of that was the Pacman and Gottlieb acquisition, which we set out in the management report, and a 5.8 million decline on the organic side. So it's roughly about 4.8%. And as Peter described, the impact in the first half of the year was primarily volume, with a small amount of increment in price inflation. Again, going to manufacturing business, the manufacturing business was broadly flat year on year organically, and Sutton's contributed 2.5 million of extra sales to the business. And we had, clearly the acquisition was a key part of the profit growth, but we actually had growth organically of around 200,000 as well. So again, I think as I explained earlier, we have had weakening sales, we have had inflation in operating costs, but I think with the strength of the gross margin, we've made some offset to that to allow us to grow the profitability organically around about 200,000. So hopefully that covers that question.
Yeah, and I think the only thing I would add is it's always a balance between making sure we give investors enough information to make decisions on, but also not to give too much information that is advantageous to our competitors. So, we recognise both those two things in trying to share information with our investor community.
Just one maybe final question. We're just about run out of time. As executive directors, what do you each see as the key responsibilities of your respective roles? How do you meet those responsibilities?
Wow,
that's a big question.
That could take the rest of the day.
Yeah.
I mean, at the end of the day, as an executive team, we all have individual sort of responsibilities, but the group is there to ensure we have the right strategy and agree that strategy with the board. Then ensure that we've got the right plans to execute against that strategy, to make sure we've got the right measures in to measure us in terms of the execution of those plans. And then underpinning all that is, making sure we've got the right people in place with the right reward systems in place and the right career objectives in place. And in reality, that's what we spend most of our time doing, aligning those strategic, executional and operational plans and ensuring that we've got the right people properly motivated to deliver on those plans. I don't know, you want to add anything to that?
Yeah, I mean, clearly sustainability is important to us going forward, to make sure what we are doing is done in a sustainable way in terms of the products we offer our customers and the solutions we offer our customers, and also taking control of the things that we can influence internally within our business. And I suppose clearly my role is very much about the financial controls around the business and the governance around the business to ensure that the numbers are delivered on a sustainable way, and to make sure that there's proper governance and controls around those numbers that the investors see.
That's fantastic. Look, thank you guys for taking so many questions today. That's great. And of course, any further questions that do come through, the team will be able to review those and we'll publish responses where appropriate to do so on the Investor Meet Company platform. Peter, just before redirecting investors to provide you with their feedback, which I know is particularly important to you and your team, if you do have any final closing comments.
Yeah, thank you. Firstly, thank you for your support and thank you for your time today. Key themes that we've tried to share with you is firstly resilience. Secondly, that we're a very focused business in terms of the markets that we support and serve, that we've got really good market positions, that we've got significant growth potential, both organically and through acquisition. And if you look at our history, we've demonstrated, very good success. Now, I know history is, you can't be sure of history going forward, but we're very confident that if we execute our plans as we've previously done, we can continue to sustain the success and the growth and profitability of the McFarlane Group.
That's fantastic. Peter, Ivor, thank you indeed for updating investors today. Now, please ask investors not to close the session. You should be automatically redirected to provide your feedback in order the management team can better understand your views and expectations. This will only take a few moments to complete and is greatly valued by the company. On behalf of the management team at McFarlane Group PLC, we'd like to thank you for attending today's presentation and good afternoon to you all.